Good afternoon. Hello out there. Wow, it's been what seems like an eternity since I've hopped on here and conducted a annuity review. We've been very fortunate and blessed to have had the opportunity to work with hundreds of clients all across the country in the last 12 months or so. The feedback and the just general praise that we've received regarding these reviews and helping people bring more transparency to this buying process for annuities, which is a very important part of their retirement. We've just had so many good things that we've received in terms of feedback and compliments, and it's just been a true blessing. So we have been very busy here at Annuity Association helping clients, and fortunately, we've had that opportunity. We're very thankful for. But we're back here to bring some more transparency to the marketplace with a brand new product or fairly new product to the market. It has been a leader or one of the leaders in the lifetime income annuity space with the income rider on a fixed indexed annuity. So I'm excited to bring this review today. If this is the first time you're watching, my name is Jeremiah Conger. I'm with annuityassociation.com. And our mission is to bring is to create a better annuity buying experience. And we do that through transparency and education and really helping prospective clients compare and contrast the features and benefits of the hundreds of various annuities available to them on the independent annuity marketplace so that ultimately they can make an informed and educated decision. If you're landing on this review, chances are you have worked with an agent or advisor that has maybe pitched this particular product to you. And if that is the case, you're probably in the situation where you're wondering if it is the true best one for your retirement nest egg, or at least a portion of it. And that's really the premise of these reviews, is to show the comparisons and the benefits and features so that you can truly understand what it is you may potentially be investing some of your life savings in. We take it very serious, and we're blessed to have the opportunity in this platform to bring this type of information directly to you. We don't charge anything for this review, obviously. The way that we are compensated is if you decide that you do want to go down that path of comparative analysis to make an educated and informed decision. We hope we can earn your trust and therefore earn your business, and that you'll purchase those annuities through us. We are an independent annuity advisory company. We work with clients in all 50 states, and we have a team of advisors that are trained and educated to bring and provide that transparency directly to you in a virtual capacity using a meeting process on Zoom. So it's a convenient and easy way for you to compare and make an educated decision. Today's annuity review will be conducted on the North American Income Pay Pro 10 fixed indexed annuity. The fixed indexed annuity, this one in particular, will have a lifetime income rider. So we're going to be talking a lot about income today. So if this is the first time you're watching, we're going to take a brief overview of the particular brochure for this product, and then we'll delve into our software, where we'll take a look at the analysis of the specific index crediting strategies, and we'll also take a look at the income calculator tool that we have at our disposal to get an idea of how the income may look for someone that is entering retirement or potentially entering retirement in the near future, to see what that income looks like. Okay, so without further ado, I'm going to go ahead and share my screen here, and that will allow me to then read our handy dandy disclaimer. So bear with me here. It's been a little while. I might be a little rusty, so I do apologize. Before we get started, if you do find this review interesting and you get some value at it, please give us a thumbs up, like and share it on your social media platforms. It helps other people find this relevant content to their annuity search as well. And, if you're interested in working with myself or one of our team of advisors, you can do that by visiting annuityassociation.com, and right on the webpage you can schedule your free consultation, as well as request your free comparison report right on the main homepage. Okay, so I'm going to go ahead and share this screen here. Bear with me. Here we go. Okay, so again, we're talking about the North American Income Pay Pro 10 Fixed Indexed Annuity. This is an independent review brought to you by AnnuityAssociation.com. This is a review, not a recommendation to buy or sell an annuity. North American Company has not endorsed this review in any way, nor do we receive any compensation for this review. This review is meant to be an independent review at the request of website visitors so they can see our perspective when breaking down the positives and negatives of this particular annuity. Before purchasing any investment product, be sure to do your own due diligence and consult a properly licensed professional should you have specific questions as they relate to your individual circumstances. All names, marks, and materials used for this review are property of their respective owners and not that of AnnuityAssociation.com. While care has been made to ensure this review is complete and accurate, no guarantees are made to the completeness or accuracy. Okay, so let me go ahead and get the brochure pulled up here, and then I will share that part of my screen as well. Here we go. Thanks for joining us today. We appreciate it. Okay. Here we go. Okay, so today we are discussing the Income Pay Pro Fixed Indexed Annuity. This is offered by North American Company for Life and Health Insurance. And this particular product is centered all around guaranteed lifetime income. And that guaranteed lifetime income is meant for whatever the future holds. Many people are concerned about whether or not they have focused enough on preparing for retirement. With the disappearance of pension plans, a potential uncertain future for Social Security, and a fluctuating economy, consumers are facing a challenge to know where to turn with their retirement savings. When you are nearing retirement, you want to make sure you can protect your retirement nest egg. Protect and grow what you have worked hard to earn. You want to make sure your retirement savings are not only protected from market downturns, but that there's opportunity for growth as you approach retirement. Protection from inflation, and you want to be prepared for the rising cost of goods and services. You also need to be prepared for unexpected costs. You may want the access to additional funds in case unexpected nursing home costs arise and you need care. And last but not least, the flexibility to enjoy your retirement. You want control of your money, to travel, to start a new hobby, buy a vacation home, to help pay for whatever it is that you want to do in your golden years. The Income Pay Pro by North American Company Fixed Indexed Annuity could help you and your family plan for the future. Let's read on to find out how. So basically, this annuity can provide a retirement paycheck that lasts a lifetime. The Income Pay Pro is a modified single premium fixed indexed annuity with an embedded guaranteed lifetime withdrawal benefit, also referred to as the glwb rider, offering competitive guaranteed lifetime income. Lifetime payment amounts, which I refer to as LPAs, are made to you as long as you live, or if applicable, a joint annuitant lives. So if you have a spouse, you can structure this for joint benefit, and it will protect both lives. And it's essentially a retirement paycheck you can count on. So for retirement income, the Income Pay Pro provides multiple options for taking retirement income. So you're in the driver's seat in determining how and when you start receiving payments. You also have the ability for growth through the fixed and index account options that offer upside potential without downside market risk. Your premium is protected from market downturns. So in a fixed indexed annuity like the Income Pay Pro 10, you will have a guarantee contractually of principal protection. So in adverse market conditions or down markets, your peace of mind is still whole because you do not have to worry about incurring any losses due to those downturns. You also have liquidity options. So if you need access to funds, the Income Pay Pro has different liquidity provisions that can help you when you need it most. So that's one of the many benefits of how an indexed annuity with a lifetime income rider differs from a traditional annuity or immediate income annuity or single premium immediate annuity. They have many different names. Is that you're not technically annuitizing the contract, so therefore you still maintain control over the principal investment, which is a nice peace of mind to have. With the Income Pay Pro Fixed Indexed Annuity, you can take advantage of the benefits of fixed annuity offers, such as tax deferral, which helps improve your growth potential. Your annuity's value grows on a tax-deferred basis, meaning more of it is working for you. Tax-deferred growth means you don't owe taxes until you access funds, and allowing more time for growth potential. Work with your tax advisor to find out how this might work for you. Under current law, annuities grow tax deferred. An annuity is not required for tax deferral in qualified plans, and annuities may be subject to taxation during the income or withdrawal phase. Please note that neither North American nor any financial professionals acting on its behalf should be viewed as providing legal, tax, or investment advice. Consult with and rely on your own qualified advisor. Annuities may also offer the ability to avoid probate. By naming a beneficiary, you typically minimize the delays, expense, and publicity often associated with probate. Again, consult and rely on your own legal or tax advisor regarding probation. Annuitization payout options. By annuitizing your contract, electing an annuity payout option, or by turning on lifetime payment amounts, you have access to a guaranteed income stream that will last as long as you live, or if applicable, your joint annuitant lives. The issue ages for the Income Pay Pro by North American is 40 years young to 79 years young for both qualified and non-qualified accounts. And the minimum premium for the Income Pay Pro 10 offered by North American is $20,000 at issue for both qualified and non-qualified funds. So let's talk about more details for the Income Pay Pro annuity. To understand how your annuity works, it's important to first understand a few basics about the accumulation value, your guaranteed lifetime withdrawal benefit rider, and the guaranteed lifetime withdrawal benefit value in your Income Pay Pro annuity. So the accumulation value equals 100% of premium plus any interest credited less any withdrawals, if any. Your accumulation value is the value used to determine penalty-free withdrawal amounts and your surrender value. The surrender value is the amount you would receive if you surrendered your contract during the surrender charge period. Additionally, any remaining accumulation value plus potential interest credits for the partial contract year as of the date of death may be paid to your beneficiaries upon your passing. You also have, if you purchase the Income Pay Pro 10 fixed indexed annuity from North American, the guaranteed lifetime withdrawal benefit rider and lifetime payments. The embedded guaranteed lifetime withdrawal benefit rider is designed as a way to generate income payments for life, which North American refers to as lifetime payment amounts, without incurring any applicable surrender charges or market value adjustments, even if the accumulation value is ever reduced to zero. The lifetime payment amounts are based upon the age of the covered person or persons, if it's set for joint. And the LPA is based on the youngest covered person if there is a joint structure. The guaranteed lifetime withdrawal benefit value initially equals 100% of your premium and is used to calculate your lifetime payment amounts. This value is not the same as the accumulation value and is not available as a death benefit. This value is never available as a lump sum withdrawal. So the easiest way that I summarize, an indexed annuity with a lifetime income rider is essentially breaking it into two columns, which they've done for us on this brochure. Or I'll have clients do a T-chart exercise where we'll discover the definitions of the accumulation value and the income benefit, or in this case, the guaranteed lifetime withdrawal benefit value. But North American does a really good job on how these two values work independently from one another. And why it's important to understand it is because, if you're purchasing it for lifetime income, typically you're going to have some form of guaranteed growth during the deferral phase on that guaranteed lifetime withdrawal benefit value. On the accumulation value, that's your walkaway money. That's the money that if you decided to surrender, which is basically canceling the contract or foregoing the income and walking away with the cash, the accumulation value is your walkaway money. It's your surrender value. So the accumulation value can be increased by the premiums received the earlier of the first contract year and lifetime payment election, and any interest credits that have come from the index crediting strategies or the fixed account. It can be decreased by any withdrawals or any lifetime payment amounts once the lifetime income is activated. And the accumulation value is used for calculating penalty-free withdrawals, annuity payout options, death benefit calculations, and surrender value calculations. So again, accumulation value is your walkaway money. It's also your death benefit. So if you decide, if you do not decide, but if you do pass away, and you have a designated beneficiary, which you will, it's required by the contract. Your beneficiaries will receive whatever's left in that accumulation value at the time of death. If you've turned on income, you still have accumulation value, or the potential to have accumulation value left, because although you've turned on the income, you still have the ability to earn indexed interest on that accumulation value as long as there's money in that side of the account. Okay. You do also have that liquidity. So that's what they're referring to there for penalty-free withdrawals. So if you're during the first 10 years of the contract and you need to tap into that accumulation value for a rainy day event, you can access up to 10% in most indexed annuities, and access some of those funds to help with that rainy day. In regards to annuity payout options, because it is an annuity, you do have the ability to still annuitize the accumulation value in exchange for a lifetime payment or a period certain payment. And annuitization means you're giving up control over that accumulation value in exchange for that lifetime payment. But in most cases, that would be redundant in this product because you have an income rider, which gives you the flexibility to still receive lifetime payments without giving up control over that accumulation value. So it's very rare that someone would annuitize this type of product, but you do still have the option if you decide that's what you want to do. And you never know, maybe the payment would be higher than the income rider would provide. That's something we could compare for you at that time. The guaranteed lifetime withdrawal benefit value is increased by the premiums received the earlier of the first contract year and lifetime payment election. And it can grow at a guaranteed 7% compounded annual interest rate, which is referred to as a roll-up, prior to the lifetime payment election. So each year that you defer this income, the income benefit or guaranteed lifetime withdrawal benefit value is going to grow at a guaranteed 7% a year, compounded every single year until you turn on the income. And in this particular product, you can defer that income stream for up to 10 years and still capture that guaranteed 7%. So very powerful product if you're looking to avoid market risk and you want to put more certainty in your portfolio, especially on an income perspective. That guaranteed 7% with no market risk and no dictation of the markets either is very powerful. And the best part about it, it's all contractual. So it's going to provide us a predictable way to plan for retirement because we know how much income this is going to generate on a guaranteed contractual basis. That's why people buy these, because of what they will do, not what they might do. The guaranteed lifetime withdrawal benefit can be decreased by withdrawals. If you take any money out of the accumulation value, leveraging that free penalty-free withdrawal, it will reduce the amount of benefit on the guaranteed lifetime withdrawal value. This includes those penalty-free withdrawals, any required minimum distributions, and lifetime payment amounts that can also decrease that value as well. And the glwb value is used for calculating lifetime payment amounts. So how can you enhance your retirement with the Income Pay Pro? The Income Pay Pro offers a mix of both fixed and indexed account options, including the fixed account, which provides a fixed interest rate that is guaranteed for the first contract year. And the fixed interest rate is declared by the company each year thereafter. So it's annual renewable in terms of the rate, but will never be less than the minimum guaranteed fixed account provided by your contract. You also have the ability to set your strategy with total control over how your initial premium is allocated between your fixed account or indexed account options. You can choose from several different crediting methods. And that's kind of where we come into play, is really focusing on the analysis of the available index crediting strategies. What we have found over the years and hundreds of clients that we've worked with is that, not every index itself is created equal, nor is any index crediting strategy. So it's important to note the differences and have a true way of comparing the available indexes and index crediting strategies so that we can ensure that we choose the very best combination of strategies to help meet your defined objectives. So in this product, there's going to be monthly point-to-point with index caps, annual point-to-point with index caps, annual point-to-point with index margins, annual point-to-point with participation rates, 2-year point-to-point with participation rates, and a fixed account. So a lot to know there. That's part of our process, as we'll educate you on the strategies that we find to be the most optimal based on our analysis, and we'll educate you on why that is and show you detailed analysis on how we came to that conclusion. So if you're looking to compare that, that's something we'd be happy and honored to do for you. The accumulation value is 100% of your premium allocated to the fixed and indexed account options, less any withdrawals plus any interest credits. The accumulation value will be reduced by the amount of any withdrawals, including any rider charges, but cannot be decreased due to negative index performance. The surrender value is the amount that is available at the time of contract surrender, and the surrender value is equal to the accumulation value subject to the market value adjustments, less any applicable surrender charges and state premium taxes. The surrender value will never be less than the minimum requirements set forth by state laws at the time of issue in the state where the contract is delivered. The surrender value will never be less than 87.5% of all premiums, less any partial surrenders, after market value adjustments or reduction for surrender charges, and reduced by any applicable rider charges accumulated at 1%. So how transfers work? Did you know that you may elect to transfer funds between the fixed account and indexed account options after the first contract year for the annual index account strategies, or every 2 years if you choose the 2-year point-to-point strategy? You may also elect to transfer between strategies annually or every 2 years for amounts allocated to the 2-year strategy. Based on current tax laws, these transfer between options will not be taxable or subject to surrender penalties, and the transfers must be specified dollars or whole percentages, not decimals. So that's something that we add value to our client base, is that once you become a client of Annuity Association, we're going to work with you on an annual or biannual basis and have a review process that we conduct with you. And we'll go over the analysis and performance of your current index allocations and decide and make an educated decision on whether or not we should reallocate those funds to some of the other index options that are available, or if we should just leave them be. But that's something that we provide free of charge once you become a client of ours, and it's something that we strive in terms of just continuing an ongoing relationship to add more value to you. So here's some ways that we can set your strategy. In addition to the fixed accounts, here are the crediting methods. You have your monthly point-to-points, annual point-to-points, and 2-year point-to-points. Some of those will have index caps, which is basically if it has a cap, it's measuring it for 1 year or monthly, depending on the strategy. And if it has a cap, it's going to pay up to that cap. So for example, if you're in the S&P 500 index that has a cap of 10%, the payout or interest credit will pay out up to 10%, assuming the performance of the S&P was at least 10% or higher. If it's less than 10%, you would just receive all of whatever that amount is less than that 10% cap. If it's a participation rate, that's very simple to understand. It's how much of the index's performance for that annual or 2-year period of time do you participate in. So if, again, S&P goes up 10% and you have a 50% participation, the most interest you could earn in that scenario for that 1 year or 2-year point-to-point would be 5%. 50% of 10% is 5%. Okay? In the Income Pay Pro 10 fixed indexed annuity from North American, there's going to be a multitude of index options that we can select from or choose from. We have the Standard & Poor's 500 Index, which is widely regarded as the best single gauge of the large cap U.S. equity stock market since the index was first published in 1957. The index includes 500 leading companies and leading industries of the U.S. economy. We also have the S&P Multi-Asset Risk Control 5% Excess Return Index, or what's easily known as the S&P Mark V. And this is a multi-asset excess return index that strives to create more stable index returns through diversification, an excess return methodology, and volatility management. The index manages volatility by adjusting the allocations among multiple asset classes and by allocating the cash in certain market environments. The index is managed to a 5% volatility level. We also have the Fidelity Multi-Factor Yield Index 5% Excess Return Index and the Morgan Stanley Dynamic Global Index. And last but not least, the S&P 500 Low Volatility Daily Risk Control 5% Index. So I'm sure you're wondering, well, which one's the best for your unique situation? That's something that we really pride ourselves on, is the depth of index analysis and crediting option analysis. So that's something that we will help you with in our meeting process. And if you're interested in working with us on your annuity buying process, we'd be honored to have that opportunity. You can do so by visiting annuityassociation.com, and right there on the main page, there is an area where you can request your free report, and click the button to submit that request. You'll be taken to a series of questions, one of those being, would you like to be contacted by an advisor? You'll simply answer yes, and one of us will reach out to you in a timely fashion to see how we can help point you in the right direction. So the growth potential from the Income Pay Pro fixed indexed annuity, there's several opportunities that can take advantage of that you can take advantage of as you build your retirement savings. So your annuity can grow through the accumulation value, and that is the interest earned in the fixed and indexed accounts, and it's applied to your contract's accumulation value. You also can receive growth on the income side, which is through the Guaranteed Lifetime Withdrawal Benefit Rider. The embedded Guaranteed Lifetime Withdrawal Benefit Rider is designed as a way to generate income payments for life without incurring any applicable surrender charge or market value adjustments, even if the accumulation value is reduced to zero. The lifetime payment amounts are based on the age of the covered person or persons if it's in the joint structure, and the lifetime payment amounts are based on the youngest covered person. The Guaranteed Lifetime Withdrawal Benefit Value is used to calculate the lifetime payment amounts, and this value is not used to calculate the death benefit or penalty-free withdrawals and cannot be withdrawn as a lump sum. This value can grow based on the Guaranteed Lifetime Withdrawal Benefit roll-up rate, also referred to as the GLWB value increase percentage, prior to the lifetime payment election date, and any premiums received the earlier of the first contract year and lifetime payment election. Withdrawals will reduce the Guaranteed Lifetime Withdrawal Benefit Value proportionally, and the Guaranteed Lifetime Withdrawal Benefit Value initially equals 100% of your premium. The Guaranteed Lifetime Withdrawal Benefit Value is not the same as the accumulation value. So in a nutshell, what they're saying with a lot of that legalese terminology is that the Guaranteed Lifetime Withdrawal Benefit Value is independent from the accumulation value. So the indexing options do not influence, in this case, the Guaranteed Lifetime Withdrawal Benefit Value. What does influence the values of the GLWB are the contractual rates that are not determined by the markets or dictated by the returns of the markets. It's going to be all contractual. And in this case, the Guaranteed Lifetime Withdrawal Benefit roll-up amount, which is the term they use, that is how the income benefit or Guaranteed Lifetime Withdrawal Benefit value grows during that deferral phase. In this case, they're offering a 7% roll-up rate. So that's going to compound for up to 10 years. So if let's say you're 55, you're planning to retire at 65, and you purchase this annuity, rest assured, no matter what happens in the next 10 years, you have an income benefit pool that's growing at a guaranteed 7% a year. So whatever money you put into that premium investment upon contract issue, you're going to receive 7% on that money that will then be later used and calculated to determine your lifetime payout percentage or your lifetime payment amount. So all of that is contractual. It adds a lot of certainty, predictability, and peace of mind because you don't have to worry what's going to happen the next 10 years. So for those of you familiar with the sequence of returns risk of retirement planning, this helps mitigate unfavorable sequential rates of return during that 10-year deferral phase and helps you plan with more certainty. So it's a great way to leverage contractual guarantees for income that'll last a lifetime. So how we determine your lifetime payment amount is taking, number one, the Guaranteed Lifetime Withdrawal Benefit Value, which initially equals 100% of your premium and is used to calculate your lifetime payment amount. So if person A, let's call him Al, good old Al there, Albert, he purchased an Income Pay Pro fixed indexed annuity with $200,000 in premium. The following table illustrates what this means for his initial guaranteed lifetime withdrawal benefit value. So the premium was $200,000. That gets credited to the guaranteed lifetime withdrawal benefit value column. And then step 2 is where the roll-up rate applies. So they're going to take that 7% contractual guaranteed 7% roll-up rate and compound it each year of deferral. The roll-up rate is a guaranteed rate that's applied only to the guaranteed lifetime withdrawal benefit value and compounds annually for the roll-up period. It offers growth for your guaranteed lifetime withdrawal benefit value, even if you take a penalty-free withdrawal from your accumulation value. So remember, you have 2 columns, accumulation value, glwb value. If the lifetime payment amounts are started during the 10-year period, the roll-up rate will no longer be applied in following years. So for example, you can max defer and receive that 7% compounded roll-up rate for a total of 10 years. But let's say Al here in our example is wanting to retire in 5 years. Well, he's going to capture that 7% guaranteed roll-up for all 5 years. But once the income's activated, that 7% is gone and he doesn't receive that any longer moving forward. So the roll-up rate is applied when no withdrawals in excess of the available penalty-free with partial surrender are taken, and the roll-up rate is not applied when LPAs have been elected or withdrawals in excess of the available penalty-free partial surrender are taken. And then step 3 is what's called the lifetime payment percentage, which is also contractual. It's set in the contract when your annuity is issued. The lifetime payment percentage, which is the percentage of the guaranteed lifetime withdrawal benefit rider value, whatever that amount is, that lifetime payment percentage is contractual. So you just take the 2 numbers, multiply them together, and that's going to equal your lifetime payment amount. So in this case, Al deferred for 5 years. The 200,000 grew to 280,510, and he had his contractual lifetime payment percentage is 5.55%. So his annual lifetime payment amount is $15,568. Here's one thing to note that's very interesting is if you've done any research on retirement planning, there's a rule that they call the 4% withdrawal rule, which is a percentage of withdrawal that they've deemed to be somewhat safe. However, it has been challenged in recent years given the current volatility of the markets applied with the interest rate environment, etc. However, you'll notice the payment percentages are significantly higher than that 4% withdrawal rate rule. So an annuity is the most efficient vehicle to generate guaranteed lifetime income for retirement because everything is backed by the issuing insurance companies and the risk is mitigated because you're no longer having to manage the market volatility yourself. So here's an example of what the lifetime payment percentages would be in a contract. It's going to differ between single and joint covered persons, and it's going to be based upon the age at the time of income election. So in this case, if Albert was 55, he deferred to 60, and he's going to do it single life, or in this case, he did joint, it's 5.55%. That's contractual. That's a level payment. Now, you also have the ability in the Income Pay Pro to have an increasing lifetime payment amount, which is a way to have almost a built-in inflation hedge, if you will. But you'll notice that if you elect for that option, at age 60, if Albert did, it would start to pay out a lesser amount in the earlier years, but have the potential to provide higher income in the later years. So it acts as an inflation hedge. So in my philosophy, I think that there's some redundancies in doing it that way. So if you're interested in finding out the most optimal way to build an income stream for life, to supplement your Social Security and other sources of income, and you're also looking to hedge, inflation, we'd be happy to speak with you about how we feel there's an optimal way to do so. So did you know you can begin taking your lifetime payment amounts immediately and as early as age 50? Provided that no excess withdrawals have been taken, the lifetime payment amounts will be available even if both the accumulation value and the guaranteed lifetime withdrawal benefit value are reduced to 0. You also have the flexibility to start and stop payments at any time, And electing lifetime payment amounts is not the same as annuitizing your underlying annuity contract. The start of your lifetime payment amounts is referred to as the lifetime payment election date. Future payments will not decrease so long as you don't withdraw more than your lifetime payment amount in any contract year. So the Income Pay Pro adapts to your retirement. Just as your retirement and life needs change, your retirement income should be able to adapt as well. Income Pay Pro offers 2 ways you can customize your own lifetime payment amount, as well as 2 ways to help you and your loved ones when you need it most. So you have the lifetime payment amount options, which is that level or increasing. You have the lifetime payment amount reserve. You also have the nursing home multiplier, which we haven't spoken about just yet, as well as the joint benefit for spousal continuation. So level versus increasing lifetime payment amounts. While the level lifetime payment amount design ensures a consistent lifetime payment amount you cannot outlive, the increasing lifetime payment amount option, also known as a current increasing option percentage, offers a way to help address the rising cost of goods and services in the form of inflation when it comes to your retirement. And how it works is you'll decide to start your lifetime payments, and you'll first need to determine whether the level lifetime payment option or the increasing lifetime payment option is right for you. Here's how they compare. Number 1, the level lifetime payment amount is a set amount and will not increase. It can be decreased due to any excess partial withdrawal. So if you go above that 10% free withdrawal provision in the contract, it can affect your lifetime income moving forward. Number 2, for increasing lifetime payment amounts, while you would receive a lower initial lifetime payment amount than the level payment option, your lifetime payment amount would increase by an annual increase percentage each year. The annual increase percentage will be declared as of your lifetime payment election date, but will never be less than the guaranteed minimum increasing rate. The lifetime payment amount annual increase percentage will not change once lifetime payment amounts have started, and lifetime payment amounts can be decreased due to any excess partial withdrawals. And you can contact us if you'd like to figure out the current annual increasing lifetime payment amount percentages. That rate is subject to change, and the rate that applies to your contract will be the rate declared as of your lifetime payment election date. That rate will never be less than the minimum guaranteed increasing option percentage of 25 basis points. So the hypothetical example of a lifetime payment amount option at 55, the level would be 15,568, and if you selected the increasing option, it'd be 12,202. So what you would want to do there is just look at an illustration and figure out when is the break-even point on the increasing side to where you surpass that 15,568, figure that amount of time out and how long it takes, and then gauge whether or not it makes sense for your particular situation. In this example, they're assuming a 2% annual increase on the LPA for the increasing structure. You can also make flexible payments for a flexible retirement. So North American company understands that your retirement needs may change, and perhaps you want to prepare for unexpected expense. Plan a dream vacation, pay for a grandchild's college, or simply have lifetime payment amount flexibility later in life. The lifetime payment amount reserve feature provides you the flexibility to customize your lifetime payment amounts to fit your personal goals. And how that works is any year after you have elected your lifetime payment amount, you can choose to take less than the full lifetime payment amount. At the end of the contract year, the portion of lifetime payment amount that is not taken will be placed in the lifetime payment amount reserve, subject to the maximum lifetime payment amount reserve. The lifetime payment amount reserve value is available to be taken as a lump sum at any time or periodically withdrawn until depleted. The lifetime payment amount reserve is not available after the maturity date. And here are 2 hypothetical scenarios of how you could use the lifetime payment amount reserve compared to taking the full lifetime payment amount. So here in scenario 1, lifetime payment amount that's taken is 15,568. But if you look at scenario 2, they're taking a reduced amount and then taking half of it and putting it into that lifetime payment amount reserve bank. The very next year, they take half, and so that reserve bank grows again. And then the third year, they're growing, in this case, year 7, they're taking 15.5, therefore reducing some of that reserve that they have in place. Same next year, they have 15,568. 5191 is reduced down at the bottom there, and then again, there's nothing left in the reserve. Scenario 3 is a lump sum withdrawal. So they're taking immediately a smaller income the first few years, adding to that bank, and then they're taking a huge lump sum withdrawal in the following years. Pretty cool. And did you know the lifetime payment amount reserve equals or exceeds the accumulation value? If that happens, the LPA reserve has reached its maximum. If the accumulation value is reduced to zero, any lifetime payment amount reserve at that time is paid to you in a lump sum, and the lifetime payment amount reserve is no longer available. As long as the accumulation value is greater than zero, if the lifetime payment amount reserve is greater than the accumulation value, then the death benefit will be the lifetime payment amount reserve instead of the accumulation value. Now, the Income Pay Pro does have a unique feature in the sense that it has a nursing home multiplier, or what we refer to as an enhanced income benefit. This is not available in the state of California. So if you are watching this, any of my Californians out there, unfortunately, this is not a feature that is approved in your state. So the way the enhanced income benefit works is it will double the lifetime payment amount when you need it most in the event you have a long-term care event. While nobody likes to think about it, the potential cost of nursing home care can take a substantial bite out of retirement savings. This, in turn, can have a negative effect on ongoing retirement income. With the nursing home multiplier, referred to as in the rider as the lifetime payment amount multiplier, this feature of your Income Pay Pro fixed indexed annuity gives you the option to receive an increased lifetime payment if needed to help with nursing home expenses or other needs. And how it works is the nursing home multiplier feature will double the lifetime payment amount if you become confined to a qualified care center as defined in the terms and conditions of the income rider. This benefit is available as early as age 50, and it can be assessed for up to 5 annual payments. This benefit does not have to be utilized for a consecutive 5-year period, so you can be flexible on when and how you receive the income. You can elect the nursing home multiplier benefit as long as the following conditions are met. You are not confined to a qualified care facility on the issue date. And you wait at least 2 years after contract issue date before requesting the nursing home multiplier benefit. And you are confined to a qualified care facility for at least 90 consecutive days, and you have provided written proof to North American of medically necessary confinement, and the accumulation value is greater than zero. On each contract anniversary after electing the nursing home multiplier, your lifetime payment amount will revert back to the original lifetime payment amount if you do not provide written proof of continued confinement. If the nursing home multiplier benefit limit, which is 5 annual payments, has been reached, you will not receive the nursing home multiplier benefit in the following year. So it'll pay out that enhanced income benefit or that doubled amount for 5 years. And it's flexible on, you don't have to take it for 5 consecutive years. You can take it for 2 years, turn it back off, and then have 3 years left is what it's saying here. So here they'll show before confinement, 15,568 in contract year 5 and 6. And then once the qualifications have been met, you then are able to elect that income benefit enhancement, which then doubles that payment amount. So you'll see that therefore they pay for 5 consecutive years. And then after the 5 years, it reverts back, to that original lifetime payment amount. Did you know if you're receiving double lifetime payment amounts from the nursing home multiplier, you can still utilize the lifetime payment amount reserve by deferring all or a portion of the doubled lifetime payment amount. During this time of need, the lifetime payment amount reserve can work in tandem with the nursing home multiplier, providing strong flexibility. And then spousal continuance. So your spouse may be able to continue receiving guaranteed lifetime withdrawal benefits after your death. If your surviving spouse is a sole beneficiary, he or she may have the option to use a spousal continuance to keep the Income Pay Pro contract and guaranteed lifetime withdrawal benefit rider in force. The table below outlines the potential outcomes. So if you're a single covered person, the surviving spouse may continue the guaranteed lifetime withdrawal benefit rider as long as the election has not been made. And it'll cover that new person until their death. The lifetime payment election date will be established by the surviving spouse, and lifetime payment amounts will be based on the surviving spouse's issue age and the attained age at the time of election. So if you initially buy this annuity and structure it for single life, but you never activated that income and you pass away, your spouse can continue that lifetime benefit rider and everything will be recalculated based upon their age and the time of election. If the lifetime payment election date has already happened, afterwards, the spousal continuation of the rider is not available. So if the contract is continued, the guaranteed lifetime withdrawal benefit rider would terminate. So the income rider would stop if the election had already started for income and you passed away, but your spouse could continue maintaining that accumulation value in the contract if they so choose. Now, if you have joint covered persons, obviously the surviving spouse can continue the benefit in both cases, and everything will be calculated based upon that joint structure for that surviving spouse. And for purposes of this rider, the owner and the annuitant must be the same. If they're joint owners, they must also be joint annuitants, and the joint annuitants must be spouses. If the owner is not a natural person, the annuitants are considered covered persons under this rider, and change of ownership is only allowed when changing from a non-natural owner to the annuitant. Options for accessing funds. So we talked about the withdrawals and penalty-free withdrawals and how they might impact your annuity. If you take withdrawals in excess of those allowed penalty-free, you won't experience the full benefits of this annuity. Withdrawals will cause your accumulation value and lifetime payment amounts to be reduced by the same percentage withdrawn from your contract, which may represent a large dollar amount than withdrawn. Excess withdrawals may be subject to surrender charges and market value adjustments and will ultimately impact your future lifetime payments. Penalty-free withdrawals, like most annuities, you'll be limited on when and how much you can withdraw from your annuity penalty-free. However, Income Pay Pro allows you to access a portion of funds each year. Starting in the first contract year, you may choose to take a penalty-free withdrawal, also known as a penalty-free partial surrender, of up to 10% of the beginning of the year accumulation value each year. Taking out more money than what's available penalty-free will incur a surrender charge, and a market value adjustment may also apply. Withdrawals may be treated by the government as ordinary income, and if taken before 59.5, you may also have to pay a 10% IRS penalty. Withdrawals will reduce your accumulation value accordingly. You also have annuitization payout options, which we're not going to spend a lot of time on since it's not a very common feature, but if you are interested in exploring that, please reach out to us and we'd be happy to do that for you. Some of these are a few redundancies, but there are some finer points of other features. The tax treatment of income. If you choose to put money that was already taxed, your annuity would be considered a non-qualified plan. A portion of each income payout from a non-qualified plan would be considered a return of premium. That amount would not be taxable, but any credited gains would be. Okay, so again, consult your licensed professional for any legal or tax and investment advice. Market value adjustments with external indexes. Your contract also includes a market value adjustment feature, which may decrease or increase your surrender value depending on the change in the market value adjustment external index rate since your annuity purchase. Due to the mechanics of a market value adjustment, surrender values generally decrease as the market value adjustment external index rates rise or remains constant. When the market value adjustment external index rate decreases enough over time, the surrender value generally increases. However, the market value adjustment is limited to the surrender charge or the interest credited to the accumulation value. Market value adjustments are applied only during the surrender charge period to surrenders in excess of the penalty-free amount. So there is a death benefit. That's a common question that we receive is, a concern is if I die, I don't want the insurance company to keep my money. Keep in mind, a fixed indexed annuity in most cases will always have a death benefit, especially before any income withdrawals have been taken. The death benefit is payable upon the death of an annuitant or owner before the maturity date. The death benefit is the greater of the accumulation value as of the date of death or the minimum surrender value as the date of death. The death benefit equals the accumulation value plus potential interest credits for partial contract year as of the date of death. The death benefit may be reduced for premium taxes at death as required by the state of residence. Again, consult with your legal or tax advisor. Now, the maturity date, that's a term that's loosely used. It's a general term, but in an annuity, the maturity date is completely different than a maturity date in a bond or a certificate of deposit offered by a bank. A maturity date in an annuity is like how long the contract could go on for. In most cases, a maturity date in these types of annuities is going to usually be between age 95 and 100. So if you're 60, you have a 30-year maturity date. The maturity date is not the same as surrender date or surrender period. In this case, it's a 10-year surrender period. So you can walk away after 10 years and pay no penalty if you surrender the contract. On the contract's maturity date, 3 options may be available. Number 1, you can elect to begin taking annuity payments as defined in the contract. Number 2, if maturity date of the contract is after the lifetime payment election date, continue the lifetime payment amount under the terms of the guaranteed lifetime withdrawal benefit value for the life of the annuitants. The lifetime payment amount will continue, but all other rights and benefits under the contract, including the death benefit and surrender value, will terminate, and additional premium will not be accepted. So basically, if you were to live to be 100, you would be given 3 options to choose from in an effort to figure out what you're going to do moving forward. You can take the number 1 option there, which is taking annuitization payments, which is taking whatever's in the accumulation account and annuitizing it. Number 2, if the lifetime payment has already been elected, you could continue receiving that lifetime payment amount, but you would lose access to the accumulation value and forego any death benefit at that time. Or number 3, if the maturity date of the contract is before the lifetime payment election, you can elect to take the lifetime payment amount under the terms of the guaranteed lifetime withdrawal value for the life of the annuitant. And the lifetime payment amount will continue, but all other rights and benefits under the contract, including the death benefit and surrender value, will terminate, and additional premium would not be accepted. So for that lifetime withdrawal benefit rider charge, there is a 1.15% value that's charged against the accumulation value upon each anniversary date. And your annual charge is calculated by multiplying a charge percentage by the guaranteed lifetime withdrawal benefit value on the contract anniversary. And that charge will be deducted from your accumulation value on each contract anniversary until either your contract or guaranteed lifetime withdrawal benefit rider terminates. If you terminate this rider, you will not be reimbursed for the charges previously incurred. And the annual guaranteed lifetime withdrawal benefit charge will be deducted each year, including years when the withdrawal is taken, years after lifetime payment amounts have started, years when no interest is credited to the contract, and years during which you are confined to a qualified care facility. And last but not least, when the rider continues following spousal continuance. And although fixed indexed annuities guarantee no loss of premium due to market downturns and fluctuations, deductions from your accumulation value for optional rider charges could, under certain scenarios, exceed interest credited to your accumulation value, which would result in a loss of premium. So with the guaranteed lifetime withdrawal benefit rider, there is some termination clauses, and they understand at North American that your needs may change. And that's why you have the option to terminate this rider at any time. However, terminating that rider forfeits access to the guaranteed lifetime withdrawal benefit value, the lifetime payment amounts in the reserve bank, and the multiplier features. Termination of the rider will not automatically terminate the contract, but once terminated, that rider cannot be reinstated and you will not be reimbursed for charges previously incurred. The Income Pay Pro guaranteed lifetime withdrawal benefit rider will terminate upon change of ownership and unless pursuant to the spousal continuance provisions of the contract and this rider. Upon payment of a death benefit under the contract to which that rider is attached, upon death of covered persons during settlement phase, such as the covered person that is no longer living, or on the maturity date of the contract. Upon the date annuity payments begin under the contract, or on the date the contract accumulation value, the guaranteed lifetime withdrawal value, and the lifetime payment amount all equal 0. Upon divorce, to the extent of the provisions of the divorce decree violate the ownership requirements of that rider, and on the date the contract to which this rider is attached or terminates, when you give us written notice requesting termination of that rider. Let's talk about the surrender charges. So during the surrender charge period, in this case it's 10 years, a surrender charge is assessed on any amount withdrawn as partial or full surrender that exceeds the available penalty-free amount. A surrender charge may result in a loss of premium. Electing an annuity payout option before the end of the surrender charge period may cause you to incur a surrender charge. A surrender during the surrender charge period could result in a loss of premium, and surrender charges may vary by state. So here's an example of the surrender charge schedule. It is going to vary by state. You'll notice in majority of the states, it's 10% starting out in the first couple of years and then goes down 1% every 2 years. And then in the year 7 and beyond, it goes down by 1%. And let's go ahead and see what else we have here. That's going to wrap up the brochure. So now, last but not least, North American is owned by Salmon's Financial Group, who's committed to their customers, their distribution partners, employees, and communities, and that are deeply rooted beliefs that they will grow stronger together. Salmon's Financial and North American hold an A+ rating through AM Best, S&P Global, and Fitch. So they're a very financially stable organization who holds true to their guarantees. All right, so now if you're still here with us, I appreciate your time. We're going to spend a few minutes looking at our software, where we're going to take a look at the index crediting strategies and specificity to determine, what the potential is on those particular strategies, as well as identifying the top strategies within this annuity. So using our software, which is designed to analyze each specific index crediting strategy and assess the participation rates, caps, and/or spreads, and then take it through a series of back tests to determine what the average rates of return would have been during the last 10, 15, and if the data is available, 20 years. And so coming in number one for the Income Pay Pro offered by North American is the 2-year point-to-point Morgan Stanley Dynamic Global Index with participation rate. At the time of this recording, the participation rate that's offered is at 155%. And so essentially what that means is whatever the raw performance is of that Morgan Stanley Dynamic Global Index over that 2-year period, let's say it's 10%. They would take that raw performance of the index, multiply it by your participation rate, in this case, 155%. And that net interest credit you would receive to the accumulation value would be 15.5%. So taking all of those factors and formulas into consideration and back testing it over the last 10 and 15 years, those numbers to the far right are going to be the average annualized rates of return, assuming that we owned this contract during that time frame and all of the contractual parameters were created equal. So if we had 155% par rate over the last 10 years of owning the contract, the average annualized rate of return for that index strategy would have been 8.32%. Now, if you look just below that, we're also able to identify the best 10-year consecutive period over the last 20 years, as well as the worst 10-year consecutive period over the last 20 years. In this case, the best 10 at 11.45 and the worst 10 at 8.32. Over the last 15 years, if everything was created equal and we owned this contract during that time and everything was the same, we would have earned a 10.22% average annualized rate of return on the accumulation value. So very fair numbers, if not more than fair. These are great figures. And what really helps us understand the power of a fixed indexed annuity is the guarantee of principal protection. So what plays into some of these higher returns is that we're not incurring any of those negative years in those down markets, in the times that the markets are performing negatively. So by avoiding those negative losses, and we're just getting a zero for those down years, it helps the average maintain and be more stable and healthy. The second best index strategy using the same analysis is the 1-year point-to-point with the participation rate on that same Morgan Stanley Dynamic Global Index. At the time of this recording is at 110% participation. That equates to a 6.79% annualized rate of return over the last 10 and a 7.57% over the last 15. 8.55 on the best 10, 6.79 on the worst 10. Coming in third is the 2-year Fidelity Multi-Factor Yield 5% excess return. That's a tongue twister. Point-to-point with participation rate. This is 155% par as well. 6.32 over the last 10, 7.89 for the 15, and 7.35 for the last 20. Now, the 20-year is interesting because it's going to include two of the largest economic downturns in our nation's history, the early dot-com bubble in the early 2000s, as well as the global financial crisis in 2007 and 8. And you'll see even during that time frame, we still maintained a healthy average at 7.35. Now, best 10 at 10.09, worst 10 at 6.32. If you like the S&P 500, it's coming in at fourth with the 1-year S&P 500 point-to-point with the monthly sum cap strategy, 5.13% over the last 10, 3.68 over the last 15, and 3.91 over the last 20. And then you'll see the 1-year Fidelity coming in fifth, and then the 2-year S&P Mark V coming in sixth. So this is just an example of the way we're able to help you understand the available index crediting options and the analysis and tools that we have to research the various options available to us so that we can help you make an informed and educated decision on how to give yourself the most potential for accumulation value growth, as well as maintaining that accumulation value over time. Again, we will conduct annual and biannual reviews with you to help make an informed decision on how we decide to allocate your premium funds and any interest earned moving forward in the contract to those various index options. Okay, so one more step here is we're going to now take a look at the income rider calculator to see, how this thing stacks up. For now, we're just going to take a look at a sample $100,000 premium investment for a male age 60 in the state of Florida. And we're going to look at the specific Income Pay Pro product to determine, what this might look like. So this is our guaranteed income rider calculator. We house all of the available indexed annuities on the independent annuity marketplace with lifetime income to help our clients compare and contrast the incomes based upon their time of election and what they might be forecasting on when they want to turn on the income. And what we found is there might be better annuities out there for specified deferral ranges than others. So for example, the Income Pay Pro might be the #1 paying annuity for deferral years 1 through 3, but once you defer longer than 3, there might be a competing product that offers a higher rate because of the contractual guarantees found in the income rider. So it's very important that you do your due diligence and you work with an expert that can help you compare and contrast and research the annuity marketplace to help you get the most bang for your buck. If you're interested in working with us directly, we'd be honored to have that opportunity. To do so, you can visit our website at annuityassociation.com. Right there on the main page, you can click the green button to request your free report. And on that, you'll be taken to a series of questions. One of those being, would you like to be contacted by an advisor? You simply answer yes, and one of us will reach out to you in a timely fashion to see how we can help you in your annuity buying process. So assuming that a male age 60 in the state of Florida was going to defer for 5 years, activating income day 1 of contract year 6 at age 65, the Income Pay Pro would pay approximately $9,624 on a guaranteed basis. Now, you're probably wondering, how does it get to that amount? Well, if they put $100,000, remember, this particular product is going to guarantee an increasing roll-up rate each year of deferral. And I do apologize, but it looks like we might have been looking at a slightly older brochure. The interest rate on the compounded roll-up rate that's offered in the annuity income rider is actually 8% now. So my apologies. We were reading 7% before. It's actually 8%. So I do apologize. But essentially what's occurring there is each year of deferral, so in this case 5 years, that $100,000 premium is growing by a compounded 8% on a guaranteed basis per year. And so it's growing that guaranteed lifetime withdrawal benefit value to $146,933. And then based on this being structured for single annuitant, at the age of 65, this person would receive a payout of 6.55% of that $146,933 income pool, which would equate to $9,624 a year. Here you see that enhanced income benefit for the nursing home care, which would double that amount to $19,248. And if you were looking at joint, we could simply calculate a joint structure. Let's say that this male has a spouse that he's married to. It's also 60 years of age, and we can determine how that would that would impact the amount of income paid. So what's occurring here is that the payout percentage is a little bit less because it's covering 2 lives versus 1, but the $146,933 still remains the same. If you are interested in researching that increasing income payout, which can be a built-in inflation hedge, if you will, we can also help you determine what that income might be based upon that structure as well. So that's going to wrap up the review. You'll see just real quick, if we were to continue deferring it, you can see how the incomes change. So if you're interested in comparing this annuity to hundreds of others on the independent annuity marketplace to help you make a confident and informed decision on which annuity is right for your particular situation, we would be honored to have the opportunity to work with you. We work with clients in all 50 states. We have a team of trained advisors that are educated on the subject matter and that utilize tools such as this to help you make an informed decision, with the ultimate goal that we're bringing transparency and education through comparative analysis to help you make an informed and educated decision on which annuity is right for you. If you're interested in doing that, you can visit our website at annuityassociation.com. Right there on the main page, you can click the green button to request your free report, and we will send that out in a timely fashion. You'll be taken to a series of questions, one of those being, would you like to be contacted by an advisor? Simply answer yes, and one of us will reach out to you in a timely fashion to see how we can help. So we utilize Zoom as a platform to meet, so you can do so from the comfort of your own living room. And as long as you have a device such as a smartphone, tablet, or computer, we can get you connected and bring that transparency that you're looking for. Thanks for watching. If you like this video, you've gotten some value, give us a thumbs up wherever you might be watching this, and tune into our channel for additional reviews here in the near future. This is Jeremiah Conger with Annuity Association signing off. Thank you so much, and take care of one another. Talk to you soon. Bye-bye.